Hi. So let me check if I'm getting yes. So right. Hi. So in this video, I'm going to walk you through the discounted cash flow valuation of the leading retail firm Costco, which would also entail forecasting its financial statements, balance sheet, income statement, and cash flow. Right. So this is going to be a rather long video. So my request would be that you watch this video only if you're interested in learning a thing or two about valuation or modeling in general. And if you have any feedback or if you want to add a thing or two, then please leave your comment in the comment section, and I'll be glad to address any feedback and also learn a thing or two from you. All right. So with that said, uh, let me uh, let me go to the business. Let me talk about what kind of business is Costco in. So Costco is a membership-based warehouse. So what it means is that in order for a customer to buy a product at discounted prices, uh, the customer needs to become a paid member, right? So Costco has 4 tiers of membership. So let me just open up. I have the membership tiers open. So in the US, Costco offers 4 tiers of membership, right? So there are 2 tiers which are at $60 annually, and there are two of them which are at $120. So with $120 annually, you get some additional benefit in the form of 2% reward of cash on eligible purchases, right? So moving back to the valuation. So moving back to the Excel sheet. So with membership, what in it's for Costco is really it gets a predictable stream of cash flow from its members. That's one. And what's in it for its customers? The customer gets product at ridiculously low prices. Okay, and Costco doesn't have a wide range. It has a very limited assortment of products, and and again, you would go to a Costco not to kind of you would go to Costco to buy in bulk. You would go to Costco to buy a jumbo pack, bulk purchasing basically. And the reason why Costco is able to give products at such low prices is if you look at the gross margin, it's 11%. So what it means is that a product which you purchase from Costco at $100, they make only $11 of gross profit on the $100 purchase that you made, right? So if you compare it with some of the other retail players out there, it's especially BJ, which is in the same business of membership retailing, they make around $16 on that same product. And Target and Walmart, Kroger, although they are not really into membership retailing, but again, if you look at this table, you get some sense that Costco is actually uh, operates at razor thin gross margins. And the point being, the Costco really doesn't make any money from selling products. To be honest, the how they make most of the money is most of the net margin is basically from the membership revenues that they get from their members, right? So since they are able to basically sell products at such low prices, so what happens is they're able to draw more and more customers, which in turn has the effect of very high sales per square foot of area. In fact, Costco boasts of the highest revenue per square foot of area. Now, I'm not really counting the apples of the world. I'm just when I say that, what I meant was basically uh, I meant that Costco has the highest revenue per square foot of sales in the kind of business that they operate, in the kind of products that they offer. So what the kind of products that Costco offers, if you look at this table, they offer food and sun rays, hard lines. Hard lines would be your electronic equipment, would be your cleaning supplies, your patio, and fresh foods would be your deli, would be your bakery items, and would be meat. Soft lines would be your small electronics equipment, would be apparel. Ancillary would be gasoline and pharmacy. So, and here's the revenue margin, which has pretty much stayed uh, constant over the last few years. So, all these peers I've listed, they pretty much have the same, more or less the same product types. So, when I said high sales per square foot, I was referring to the players which offer these similar kind of products, right? So with that said, the other thing which Costco is really good at, which basically is a core value prop which differentiates them vis-a-vis their competition with some of the other retail players, is the way they manage their inventory, the way they manage their working capital. So if you look at their days of sales, days of inventory outstanding, is the average number of days a company takes to sell their inventory. So it's 31 days. So in 31 days, Costco is able to turn over its inventory, so which is 365. So if you can turn your inventory every month, so basically you have an inventory turnover of 12, which is actually quite high. If you compare it, so the other businesses, some of the other retail players out there, and even if you compare it BJ, they have a higher they have a higher days of inventory outstanding. And even if you look at days of payable outstanding, Costco has 32 days of payable outstanding. What it means is that they take around 32 days to pay back the suppliers, and PJ takes uh, more than 2 months to pay back the suppliers. So again, it shows that they're keeping the suppliers happy, paying them in a month. And yes, if you look at if you see, they are able to sell their inventory before they're required to pay for it. It may be true actually for some of the other players as well, but then again, the values, the days of inventory outstanding, days of payable outstanding are actually quite low if you compare it with some of the other retail players. Okay, and I've not really spoken about days of sales outstanding, because really in this business you pretty much get paid instantly from your customers. Okay, and yeah, Walmart has a pay days of sales of 78. I need to research as to why this days of sales outstanding is so high. I haven't done that, but again, if we see that Costco really stands out in terms of their inventory management, and in terms of what the kind of payment terms with they have with their suppliers, they're able to get early payment discounts. So again, it kind of adds to their business, right? So one of the other points I would like to mention is that Costco uh, is primarily 87% of the revenue comes from the US and Canada operations. Right now, they are actually foraying into international markets. In fact, they've built a lot of warehouses internationally in the recent past, and they continue to do so. And also, they are going big in e-commerce as well. So that's something we'll talk about when we project out revenues in a bit. And yes, and also want to mention that within the US, they 30% of their business comes from California. So they have a hugely reliant on California operations, which again, has been a consistent story since the past few years. And okay, all right. So now let's move on to so the way we'll value Costco. We have basically would value Costco's equity. Okay, so the way I have laid the sheet out is, first we'll project out revenue, cost, working capital, capex, debt into the future. Okay, and then using those projections, what we'll do is we'll model their balance sheet, income statement, and their cash flow. All right. Right. And to refresh your memory, what really is valuation? Valuation is nothing but the present value of your future cash flows or future free cash flows. And what are free cash flows? Free cash flows are the surplus cash that a company is left with after meeting their day-to-day working capital and their capital expenditure needs. So that's the basic uh, definition of free cash flow. And what we're going to do is we're going to project free cash flow to equity. Okay, and we're going to discount using cost of equity, and then we'll get the value of equity. So let's move into the projection piece of it. Okay. Now the way I have this sheet is laid out, this projection sheet is laid out is there are three components. There are four things, in fact, which we're going to project in this sheet. We are going to project our revenue, cost, working capital, and dividend. So when you talk about revenue, it's basically made up of three things: physical sales, membership, and e-commerce. What I mean by physical, it's not an industry word, physical sales. What I mean by it is the sales that they make by selling product on their floor. Membership is obviously membership revenue, and e-commerce is something that they are actually going all out in right now. Okay. So when you talk about physical sales, it's really the value is really driven from the way we've kind of broken this up here is sales per square foot of area into the total area, right? So if you talk about first let's project out, let's see their current area and then project area into the future, their warehouse and the total store area for all the warehouses. So the total number of warehouses right now that they have is around 782. Okay, and they added 20 warehouses last year, and throughout the sheet, I should have told you up front, throughout the sheet, whatever you see in yellow is based on the assumptions that I have taken, okay, based upon either their historical numbers or their the commentary that I noted down from their earning call transcript. Okay, so I'll talk more as I walk you through each of the assumptions. So this year, 2020, they said that they're going to they'll be able to construct 13 warehouses. Now the financial year ends in August 2020, so by end of August they'll be ready. They'll be ready with 13 warehouses in total, right? And in the next 2-3 years, as per the earning call transcript, they should be able to construct 20 warehouses every year. Okay. Now they said that for 2-3 years into the future, but I've assumed that pretty much they'll be constructing 20 warehouses the next 5 years. All right. So now, with that said, if we talk about total area, right now they have total area around 114 million square foot. The area that they added last year was around 3.2 million square foot. And what they keep on saying is every time they build a warehouse, uh, they make sure that it's basically a larger warehouse than some of the warehouses that they built early on, right? So, right, and that makes sense, right? If they're looking to kind of increase the sales per square footage area, so that makes sense. So right now, the average area per warehouse is around 145.6 square foot. Okay, and this number has grown by around 0.26, 0.33% every year. Okay, now that was when they were building more than 20 warehouses, right? So now since they've built only 13 warehouses, right? So the percentage by which that area should grow is around 13 by 20. I'm just scaling the last year's percentage growth percentage. So if I do this, so it would be around 0.17%, right? So 0.17% could be the growth in warehouse area next year. That's in 2020, and next year moving forward, it could be again closer to 0.26%. If we just take this number from 2019, this number, all right? So with that said, if I project out area per warehouse in the future, let me add this. So it would be, this formula, I'll drag this along, all right? And even let me also add the number of warehouses, and I'll get the total number of warehouses every year. This plus this, 795 warehouse by the end of 2020. I'll drag this along, so they'll have around 895 warehouses in the next 5 years, right? Now, so this number, area in million square foot. So before we project this out, let's first project the sales per square foot. Now, if you look at this, they basically made around $1,300 per square foot. That's huge, right? If you compare it to BJ makes around 1/3 of that number, if I remember correctly. And historically, they have been able to grow this at around 4, 5, 6% every year. 2006 there was a dip, but besides that, it has actually grown. Okay, even before 2006, it has grown. Okay. Now, so if I assume that moving forward they'll be able to grow at 2%, they'll be able to grow sales per square foot by 2%. Again, that's an assumption right now. And then obviously we'll revisit this assumption as we go along. So let's assume that they will be able to grow the sales per square foot area by 2% every year. Moving along, and let me write the right check here. So what it means is we'll circle back to this assumption, because right now we really are just making assumptions without any guidance. This is just based on historical numbers. We are being conservative. We may be right or we may be too low. All right. So right now let's project area into the future. So area totally they have around 146. They should have around 146,000 square feet of area per warehouse 2020. So total area should be the number of warehouses into the area per warehouse. Okay, divided by, now since we need to keep this in millions, so let's divide it by 10 to the power 6. So we have this in millions, and total addition in the area would be around 2.1 million this year, right? Let's drag these two guys out. Okay, so we have this. So you would see we have the sales excluding e-commerce already projected out. So basically how we have got that is we've multiplied number of warehouses with the area per warehouse with the sales per square. And that's how we have the area, which we have the sales, which excludes e-commerce. All right. So now moving on to the second piece of revenue, which is membership revenue. So totally they had around 54, 53 million members, paid members globally. Out of that, around 21 million were exec members, which were paying $120 in the US each. And then they were around, and obviously different geographies, the rates, the membership rates would be different. And the other paid members, which were not exec members, but again, they also were paid members, which pay around $60 per year here in the US. So it's around 33 million members. So if I took a weighted average of how much they made per exec member and per non-exec member, so fees that they made per exec member globally is around $90, and fees that they made per paid member is around $44.7. All right, and total exec members that they have by the end of third quarter reports already out, is around 21.8 million. So which is an increase of 0.8 million from last year numbers. So let's project the growth in exec members as well. So right now, if you see in this line item, I have the assumption built out for the growth in exec members, growth in fees per exec member, growth in number of other, growth in other paid members, growth in fees per other paid member. I've assumed that right now I've defaulted all these assumptions to just 1%. And obviously, we'll refine those assumptions, okay, to see if they kind of make sense with the numbers that have come out in the third quarter. All right. So 21% into, so if we just assume 1% growth in members, so it's 21 point, which is way low than the numbers that the number of members that they've enrolled by the third quarter. So let's go in with a 2% increase in growth rate. It's again, and if you look at the historical growth in exec members, it's kind of dance around a little bit from 1% to 10%. But really, it doesn't really give us a very good insight in terms of a trend. Well, we can see that's an increasing trend, but I certainly do not just want to make a forecast just on 3 years. So I'll just go ahead with the with 2% for now, and then fees per exec member. I'll again go in with a rather conservative assumption. Right, so I'm just doing the mechanical work of dragging and dropping, and other paid members again. Let me just do the same thing here as well, because right now everything is 1%. So if you look at this, if you look at this guy here, right now the number of other paid members that they had was around 34 million, but it's 33.2 million as per the reports. Sorry, 34 million as per the third quarter report that came out. But if you just take 1% growth, so we are way too far from 34. So let's again increase this from 1 to 2%. Okay, so we are a little bit more closer to 34 million, right? And we can basically even take a higher number, right? Why not? Because you want to be closer to the numbers that they've already reported, right? Still, I know we are being conservative, but let's start with a conservative uh, view going in, right? So fees per exec other paid member, let's again assume a 1% increase. Let's again do this, grab this and drop. Okay, so we have total growth. Okay, now growth in membership revenue, historically, it has been above 6 and 7%, right? So now let's see what's the implied growth rate, right? So let me, okay, for first we need to obviously project out membership revenue. So let's do that. Membership revenue would be number of members that we have projected into the fees per member, all right? Let me do that. Hopefully you guys are following me, and if not, you can just pause the video and just go back and watch it again, all right? Let me drag this and drop. And so the growth in membership revenue, the implied growth in revenue is around 3.2%, which is way lower than the membership revenue that we observed in the past. And again, pardon me for repeating myself, Costco makes money from membership revenue, all right? So in fact, they make most of their profit from membership revenue itself. They hardly make any money from selling products, right? So I think again we are being a little conservative, but let's let it be. So again, we'll circle back to this assumption, right? So and here's some of the metrics that I've highlighted. I'll come back to these metrics. Basically, the reason why I've kind of highlighted them, it's not necessary for us to project them out. The only reason why I have they're not really industry standard metrics, to be honest, but the way they're going to help us is they're going to help us fine tune our assumptions and make sure that we basically take reasonable assumptions. We're not too far from reality. Okay, so I'll come back to these highlighted assumptions. So for now, let's look at e-commerce. So e-commerce, what has really happened is historically they have actually uh, e-commerce has given them 4% of revenue as percent of net sales, which has shown an increase by the report that came out in this quarter because of the pandemic. Not a lot of people venturing out, and also the ticket size per order is also increased. And plus, combined with the fact that they're actually going a little big out, they're going big on e-commerce. They've recently acquired a company which goes by the name of InnoWell, which provides uh, transportation, warehousing, logistics, and last mile delivery services. So what they believe is they using that, uh, leveraging that company, they should be able to grow their e-commerce up, right? So although they haven't really given a guidance on e-commerce, so I'm going to assume that they would be able to grow from 4 to 6% 5 years. In fact, they've actually, I think 5% still conservative. They right now by the end of third quarter they are at 6% of their net sales already, right? So, but we really do not know what Q4 has in store. So let's go with a muted, conservative assumption for now. So let's project this out. Net sales would be, where's my net sales? This is my net sales divided by 1 minus. So now the reason why I've done this way is because this net sales, this sales excluding e-commerce number that you saw, this is basically 95% of their overall net sales, right? Because 5% of the net sales is e-commerce. So that's the reason why I divided it by 0.95, just so that I get total net sales. Okay? So now let me project this out. Hopefully this formula is getting tracked correctly. Yes, it is. And then we'll get the e-commerce revenue as well, 5% of net sales. Sorry, 5% of net sales should be 6%. All right. So we have basically we have the e-commerce, and now let's just let's just add to get the total revenue. So total revenue would be e-commerce sales plus net sales, which sorry, total net sales, which is a combination of e-commerce and physical sales plus membership revenue. Right. So let's add net sales plus membership revenue. Drag it along, and then we have the And let's see the implied growth rate. So implied growth rate is by this year 2020 is around 9.2%. That's what came out, and then going forward, it's actually lower, 6%, 4.7%. Again, I believe that we perhaps could be a little higher, but again, let's go with what we have for now. Okay. So moving forward now, since the revenue bit is done, all right. So let me do this. Now let's try to find in the assumption a little bit before I go on with the cost. All right. So total members that they have is 53.9 last year. Let me project this out. So I'll tell you what I'm trying to do here. Okay, right. So these are some really interesting metrics. If you look at this members per warehouse, so on average, okay, until last year, they had around 69,000 members per warehouse. So it's not an official metric that they report in their uh, filings. So what it means is that for every warehouse that they construct, they add on around 69,000 members. Okay, that's the way it works. Historically, they were around 3-4 years back. They were around 66.5, 67,000 members per warehouse, but now it has increased to around 69,000 per members per warehouse. It doesn't mean that a member can only purchase from one warehouse. When you become a member, you can purchase from any warehouse globally. But it kind of set things in perspective. So right now, if we see by 2019, we are at 69,000 mark already. And I believe that by 2025, it's not going to stay at 69,000 itself. Surely it's going to increase. So I think we have been bit more conservative with our assumptions. So let's assume that we perhaps will have more paid members than what we have assumed, because again, historically, so let's assume that we'll have around 3% members. In fact, I don't want to take a higher number for this year. I'll assume 3% from 2 years when situation stabilizes, right? So again, so you see, because we've kind of now increased our assumption on growth rate for the number of members, so we have slightly higher members per warehouse, okay, 5 years out, okay. And again, we may be too high or too low, but again, let's see how this kind of works out, right? We can obviously fine tune the assumptions as we go along, right? Now, and if we check this assumption again, so again, I would say that we are again being a little conservative again. So and the reason, and because we have been a little conservative in terms of growth in sales per square foot area, that's the reason why you see the growth rates that we have from 2021 2025, they are actually lower than what we observed in the historically three years ago, right? But still, let's still have it as we have for now. And now let's move on to the cost. So if we talk about cost, so cost has the COGS as a percentage of sales, as we saw a little while back, it's 89%. So I'm not going to make any bold assumption. I'm going to assume that it stays pretty much what it has been, 89% into net sales, not total revenue, but net sales, because total revenue would include membership, right? And that's not, and COGS is only based off net sales, at least in these calculations. So 89% of net sales, and SG&A has been at 9% historically. 2020, I've assumed 9.4. The reason why I've assumed a 0.4% increase is because they spend around 300 million because of COVID-related expenses in the last quarter, and they expect that they may have same amount of expense in Q4 as well. So this 0.4 increase actually reflects that 600 million increase in SG&A as a result of this pandemic, right? So, and I'm going to assume that as situation stabilizes, their SG&A would revert to the normal level of 9.1, right? 9.4 into net sales. Okay, so we have projected this out. Depreciation, we need to come back to depreciation. Let me write park. We are just parking this aside for now, and we'll come back when we are done with projecting out Capex, right? And pre-opening expense is basically the expenses which are involved with whenever you open a warehouse. So it has been at 0.5, 0.05, 0.06% historically. It obviously depends on the number of warehouses that you open. This year they opened only 13, so I'm assuming that it would be lower. They would incur a lower pre-opening expense. So I've kind of scaled 0.06 on 13 by 20 into 0.06. So that's how I arrived at 0.04. So 0.04 into sales. And again, I've assumed that moving forward, since we've assumed that they're going to open or 20 warehouses every year, not assumed, I would say, as per their earnings call transcript. So that's so they may incur the same pre-opening expense as they've observed in the past. All right. So taxation again is something that we'll park for now. We'll revisit it when we are done projecting our P&L. All right. Now move on to the working capital. Let's get done with this sheet and then we'll move on to the other sheets. So moving on to the working capital. Talk about working capital is current assets minus current liabilities. So when we talk about current assets, we really should not really be counting cash. So if you talk about current assets, receivables, inventory, and current assets, right? So we've already spoken a lot on inventory already. So the days of inventory outstanding is 31 days. So how we calculate that is we divided the current inventory of around 11.4 billion. We divided it by the cost of goods sold and multiplied the entire thing with 365. So that's how you get cost of, that's how you get days of inventory outstanding, which is nothing but the average number of days you take to sell your inventory. All right. So, and we've assumed that pretty much they'll continue to have this. They are pretty fanatic about the inventory management. So assume that they'll have the same inventory levels going forward. All right. So so if you make this assumption 31 into COGS divided by 365, so we have the inventory as well. Project that out in the future. Current assets, and talk about receivables. Receivables again, 4 days worth of receivables. That outstands. So again, so 4 into revenue, because here we are talking about revenue, not inventory, not cost of goods sold. 4 days worth of revenue, or not total revenue, but the net revenue divided by 365. Right, so we have this as well, and I think we can lock it. We can lock the 51. Right, and then pretty much copy the same formula for other current assets as well. I think something kind of went berserk. All right, yeah, so 92. I'm just doing the mechanical work of dragging and dropping formulas right now to just understand the intuition, right? All right, so now, so we are done with the current assets. Now so current assets totally would be sum of your receivables, inventory, and your other current assets. So let me just, so this is total, drag this for future years as well. So we have the current assets listed out. Now let's talk about liabilities, current liabilities. So account payables, they had around 11.7 billion worth of account payables, so, which translates to 32 days worth of payables. So what it means that they take 32 days to pay back their suppliers, right? So, and again, the way we have calculated it's pretty same. We divide the payables by cost of goods sold and multiply it by 365. So that's how you get payables, right? Payable days. So we've assumed that again the payables would pretty much remain the same level in future years. So with this, and 365, where is our cost of goods sold? And log this 365. And I'm going to track this, right? And current liabilities, it should be the same story. And G108, yeah, I should have done a better job at modeling that. I shouldn't have. Otherwise, I didn't have to do that. But anyway, that's fine. Okay, so now these are total liabilities. Okay, current liabilities. Now what's working capital? Current assets minus current liabilities. So these are current assets minus current liabilities. So we have the working capital. All right, and let's take the change in working capital. That's 2020 minus 2019. Simple. All right, so we have the change in working capital as well. Right now, if we talk about dividends, dividends is something. So historically, they have actually paid around 30% of their earnings in the form of dividends to their shareholders. We're going to assume pretty much they'll have the same dividend payout ratio, right? So in order for us to do that, we again need to park this in order to project this out, because we haven't really built our P&L yet, right? Right. So this is where we are at this point. So basically, now we are done with this sheet. So we need Capex for depreciation. We need P&L for taxation, and we need P&L for dividends as well. All right. So let's start plugging in the formulas. Let me do that. Since we are done with working capital, why don't I go to the balance sheet and plug some of these things in, right? Receivables, it should be straightforward. We already did that. So I'm just I'm just linking the sheet, guys, not doing something extraordinary. Right? Now, this cash should really come from the cash flow statement. So again, let's park this for now. This is going to come from your cash flow statement. Okay. And this again is going to come from this PPE, plant, property, and equipment. It's going to come from your Capex. So again, we are highly dependent on other sheets. And these other assets, we can just assume that it's going to remain the same. And with liabilities, again, we already have done the hard work of projecting it out. So let's just link the sheet. This is done. Other current liabilities, you should get that from the sheet as well. All right, and this should be sum of everything. Right, and long-term debt, again, we need to park this. This needs to come from your debt schedule that we'll see in a bit. All right. So other liabilities, and again, other liabilities, let's just assume that other liabilities will stay course. And total equity again, and this number that you see, this highlighted in green, this is again as of Q3 numbers. So just so that we really take reasonable assumptions. And again, so we need equity, we can project when we've built out the P&L. So a lot of things are reliant on some of the other items that we need to do, right? So first, why don't we move to debt? Because a lot of things are actually reliant on debt. Okay, so let's move to debt, right? So if you take a look at the debt schedule, all right, So until 2019, they had around 6.8 billion worth of debt, and which is increased to around 9 billion as of 2020, which is an increase of, so they increased debt around 2.2 billion. And now I've kind of made a note of this number because the balance sheet is not going to balance because of this hard-coded number. So I've made a note of this number because if we try to balance the balance sheet without making a note of this, then the balance sheet is not going to balance. Anyway, so just have it noted on the side. So 9 billion is their debt right now, and let's assume that they'll have pretty much same debt uh, 5 years out, right? And the current portion of debt is nothing but basically if they borrowed money 5 years back for a term of 5 years, so now next year they'll have to pay it back, right? So it becomes current this year. That's really what current portion long term debt means. And net debt raised. So we can assume that every time they raise debt, they will be able to repay it the same amount. So let's assume that net debt raised is zero, right? And the interest rate, how we calculate interest rate is we take the interest income, okay, and we divide it by the total debt every year. So that's how, so interest rate historically has been around 2.2%. So let's assume that they'll have the same interest rate future years as well, all right? So again, we need to park this aside. This is going to come from income statement, all right? So now this is the interesting part for which I first chose to take you through the debt schedule and not some of the other sheets. Because see, what happens is that Costco doesn't really uh, own all the warehouses that they operate. A lot of those warehouses, not a lot, but some of them are actually leased out. Okay, so some of them are on lease. So what it means is that they've entered into contractual agreements with third parties to pay them a certain amount every year. Okay, and traditionally the way accounting has worked is these lease obligations are actually expense. They are an item on the P&L. But what Professor Aswat Damodaran, and I follow Professor Damodaran a lot, and so what he's actually taught is that uh, that lease obligations should not really be treated any different from debt. And the reason is that what is really debt? Debt is contractual agreements that you're supposed to meet every year, right? So even lease obligations, the same thing, right? Contractual agreements you're supposed to honor as per the terms every year. So if you see these 3 years, 2017, 18, and 19, these are these obligations of the last 3 years that they've already paid out. This year, they're supposed to honor a lease commitment of around 239 million. Okay, and then moving from 2021 to 2024, these are their future lease commitments, right? And so beyond year 5, they have reported that they need to make a lump sum payment of around 2.2 billion dollars. Okay, and here we have taken, so what we have done is we have to treat this as debt and not really lease uh, expense items. Here we have, what we have done is we have taken the present value of all these future lease obligations, and we have discounted them by the pre-tax cost of debt, which we estimated at around 2.2%, right? That's how we write at 2.5 billion, which is the debt value of lease, right? And certainly Professor Aswat Damodaran would certainly do a better job at explaining this. Certainly I have in this video. I can go into detail, but if you really want to learn about this, I'll suggest you just do a search on YouTube and you'll have Professor's video, and you can see as to how you really should treat operating lease commitments. All right. So here I've taken present value of these lease commitments, okay, which is around 2.5 billion, right? So when we are done with this, what we need to do is we need to make 3 adjustments. First is we need to take the present value of these lease commitments and treat them as a debt item, and also add a synthetic or a counter asset in the asset side. Okay, and since we have created a counter asset on the asset side, what we need to do is we need to depreciate it, right? We need to depreciate it by its useful life. And so, okay, what is useful life? So useful life really here uh, is 5 years, which is from 2020 to 2024. Okay, and then moving forward, this 2.2 billion amount that they were supposed to, that this lump sum amount they're supposed to pay, uh, which they have reported in their annual report. This could actually be broken into, if we kind of divide it by average lease payments that they have made, they're supposed to make, or historically they have made, us perhaps they're supposed to make, which is around $200 million every year. If we divide 2.2 billion by 200 million, what we get is 11 years for the lump sum, 11 years as the term life for that 2.2 billion lump sum payment. So that's 11 one side and 5 years. So 11 plus 5 is totally 16 years of useful life for the entire lease commitments that they're supposed to own. So that's how we arrived at 15. Sorry, 11 plus 5, not 16. It's 4 years plus 11. So 15 years. Sorry about that. Right. So we divide the lease, we divide the lease asset, the debt value of lease or that asset value by 50, and we get the depreciation value. Right. So we need to make this adjustment in our debt, in our depreciation calculation. Right. And the operating lease expense in current year, which is 239 million. Right. So it was already being removed from the P&L, so we need to add it back. So this is another adjustment that we need to make. All right. So this is something I wanted to put up front. Now let's start uh, uh, plugging the formulas in. All right. So we already have this. So the interest expense would really be, okay, before we do that, let's go to the P&L. A lot of things are stuck on P&L. All right. So P&L, we already have the net sales. Let's just start plugging formulas, right? Plugging in the values right away. And then membership fees, membership fees as well. If we can have the total, I'm just plugging the linking the sheet, guys. We've already done all that. I'm just making sure that everything is getting linked to where it should. This is then the implied growth rate, which you already looked at and discussed, right? Let me put this here, right? And then merchandise costs, COGS, again, we have already calculated that, right? So this is done. SG&A, we have looked at this as well. In fact, the sheet should be such that I should really be able to track it. The way I've kind of laid this out is that I can't really track this. So lesson learned for next time. All right. So let's do this again. Depreciation and amortization. This is, we need to park because this is dependent on Capex. Okay. Reopening expense is again something that we have calculated already. So again, I'm just dragging, dropping this, guys. And now, yeah, this is the adjustment I want to talk about. Now, let's go to the debt sheet. So we need to add these lease obligations back to the P&L, right? This should not really be expensed, right? So let's add them. Okay, so the operating income really should be this total revenue minus COGS minus SG&A minus depreciation, which we're still supposed to estimate, minus pre-opening plus this adjustment, right? All right. I don't know why it got stuck, right? And the interest expense, again, we have that already. Interest expense. Oh, we don't have that. So interest expense we should have that, right? Right now, yeah, we should have that. In fact, we should have. There was no need to, in fact, park it. Let's. Sorry about that. So let's interest expense into this. We have the interest income, right? right? So this is done. No need to park it. Shouldn't have parked it, right? So, oopsie. Let me go to the income statement. Let me drag this along. This is an minus. So this is, we have the interest income as well. Interest expense as well. Now, interest income, I'm going to assume that it's pretty much the same as last year. I'm not going to project this out. Income before income taxes. So we have operating income, right? We have interest expense, and plus we have right. So let's just track this. So we have this, and again, these numbers are a little higher because we haven't really adjusted for depreciation yet. You're still supposed to do that when you go to the Capex sheet, which we'll go after this. All right. So provision for income taxes. Income taxes again would be 25%. Yeah. Okay. So now we can actually, something, if you remember, we actually had parked an item and in taxation sheet, right? So we can do that right now. So tax is 24%. Yeah, this year it's going to be 24%. Last year it was 22.3%. So this year till 3 quarters, they actually pay 24% tax. So I'm going to assume that pretty much the same, right? So if we go back to the income statement, the tax would be applied on your profit before tax, stating the obvious. So it would be on your income before taxes, right? So this is your taxation. Making sure that I have done correctly. So it's G17. Yeah, right. Yeah, this is correct. So now I just let me link the formulas from, let me link taxation. Right. So again, so this would be, let me drag this along. And then I'm going to assume that this pretty much is net income attributable to non-controlling interest stays the same, right? And then again, I'm going to assume, and I'm just going to drag this. So we have the net income. This again, let me remind you, this is slightly higher because we still haven't really done this accounted for debt, which we'll do right now. Okay. So we have P&L built except for this line item. Let's go to Capex sheet real quick. Right. So Capex. So instead of trying to project out land, building improvements in each and every single item, let's just project total Capex, total additions to the property, right? So last year it was 32.6 billion. And as per the quarterly report release, it's at around 34 billion as per Q3 report release, right? And they did a Capex of around 3 billion last year when they built around 2021 warehouses. So per warehouse, it kind of, not per warehouse, so per square foot addition, it cost them around $937 per square foot. And last year that number was closer to $873. And so I'm going to assume that it would be something, it would be 900 this year. That's so basically they take around $900 to $900 of Capex per square foot of area. Okay. And in fact, I should assume, if I take the inflation rate as, if I take a inflation rate, say 1%, so let me increase that by inflation as well. Okay. So that it makes more sense, right? So this is the Capex required per square foot of area every year. Okay, and the way I was estimated that was I just divided this last year Capex by this guy over here, which is really the area that they added, okay, last year. Let me show what this is, F15. F15 is, I divided it by, this is the problem with Excel sheets. You got to, okay, 3.2 million, right? So we divide, because 3.2 million is the area that we added last year by constructing those additional 20 warehouses. So that's the reason why we divided total Capex by this amount, and we arrived at the total Capex per square, right? Too much said. So now let's forecast the capex for future years. So it would be 900 into the area added for future years, right? So 900 into 2.1 million square foot of area, which is going to be added this year. So again, just need to track this out, because moving forward, they're going to build 20 warehouses every year. So obviously the capex would be higher, closer to the 3 billion that they did last year and the year before that. All right. So now let's talk about depreciation. This depreciation historically is around 4.6, 4.7 levels. It's marginally been decreasing, right? So we'll assume that we again have 4.6% depreciation this year as well. So it would be 4.6. Okay, before we do that, we first need to project out PPE or project plant, property, and equipment in the future. Okay, so last year's PPE plus this year capex. So this should be this year capex. And if you see, we already had 34 billion by Q3, and what we've estimated for the entire year is 34.5. So we are again within reasonable ballpark, is what I would say, right? So you can basically compare with Q3 numbers and see how far off and how reasonable your assumptions are, or how unreasonable you are. All right. So because at the end of the day, it's all built upon a set of assumptions. Your DCF model is as good as your assumptions, right? So, and now let's talk about depreciation and amortization. So we've already we are still yet to talk about depreciation and amortizations. It's 4.6% of your total PPE. So it's around 1,500, 1.5 billion. Project this out in the future, right? So we have the depreciation. Okay, I have this tiny note which says that do not forget to add depreciation from the debt asset, which we just estimated. So let me first do that, right? Because I gave you a long lecture on why we need to account for depreciation whenever we treat operating leases as debt assets and debt liabilities. So let me do that first. Let me add that 170, right? And then once you've done that, now let's add this to the accumulated depreciation, right? And then let's get the net value of PP, which is total PPE, total assets minus your depreciation. So you'll get net value uh, of your PP or your plant, property, equipment assets. Right? So this is done. So now this is done. So let's just revisit the assumption sheet very quickly. If there was some item which was pending on capex, okay. Let's see if there was some item which was pending on capex sheet. Well, yeah, there was one item which was pending on capex, which is depreciation. Let's me plug in those numbers on depreciation. And again, the reason why this is really helpful to do is that if you look at, see, depreciation percent of sales, we arrived at 1.1%. Historically, it was 1.1, 1.3%. So again, it kind of gives you some idea that you're not really too far off, or you're not too low or too high. You are within the reasonable ballpark. That's what happened right now. We plugged in depreciation value here in the assumption sheet, in this projection sheet. And what we saw is that we're still at 1.1% of sales, that level. So we're uh, not really just putting numbers from thin air, right? So this is done. So let me remove that. So, all right, Capex is no more dependent on this sheet. So let me move to, because right now we're just plugging numbers for Capex. So let me move to the balance sheet and see what other things that we can potentially plug in the balance sheet with. And obviously there are a lot, right? So we're not really, if it individually, we do not really project these things out. What we projected is total value of PPE, right? Let's pull this from the Capex sheet. Let's pull this guy as well. In fact, I think I can just drag and drop. Let me show you my Excel skills. Right. So net PP would really be this plus depreciation. You're done. All right. So we have other assets, and so the total assets would be the value of your current assets plus your net PPE plus your other assets. And one thing more we forgot. And your this guy over here, which I'm going to talk about, that adjustment that we did. Hopefully, I'm getting I'm still recording. Yeah. Okay. Right. So I'm going to come back to that. So remove this. Okay. Right. So now let's plug in. After making debt, we didn't, after building out the debt projections, we really did not plug debt values in this sheet. So let's do that. So so this PAC debt that we've written here, this note that we've left for us, let's go to the long-term debt sheet. Go to not the debt sheet. Let's plug in this number, 9 billion worth of debt. Let's check this out. All right, so this can go. And then now these two guys in yellow, let's put these in, right? So this plus this value, debt value pleases. So it would appear both on the debt side as well on the asset side, all right? Same thing here, same thing for, obviously for, this is debt, so it needs to be there in the debt side as well. So this is done. So we have the total, we have, so basically, again, you may say that, well, does not really make a difference, and actually it doesn't really, because you added the same thing on the asset and on the liability side. But difference it will make really is when you calculate your return on invested capital, ROIC, then in your invested capital, you need to account for debt, right? So the total, sorry, you need to account in your invested capital, you need to account for this additional debt, right? Because invested capital really is your equity plus your assets, book value of equity plus your, sorry, book value of equity plus your debt minus your cash. So in your debt, you need to add this item. So your ROIC will actually go a little low. Will actually be a little lower than it would have been had you not made this assumption. So that's why, even though it appears that it really doesn't make a difference, but it actually does, both on ROIC and also in your P&L as well, because you did those two adjustments that we just saw, right? Right. So this is done. So obviously our P&L doesn't, balance sheet doesn't balance, would not, because we still need to plug in this from cash flow, which we haven't really built out. And yeah, we need to now we can build our equity as well, because what is equity? Last year is equity plus the profit that you make every year. So let's do that. There's a P&L. It's a P&L. There is a P&L. Where is a P&L? Yeah. Okay. This net income from 2020 minus dividends we are paying out, right? So we need to pay back dividends. All right. So see, they have not really projected dividends. So, but we'll do that. Don't worry. Right. So first, let me project out dividends. I should have done that. So dividend really is 29% into your income statement, which is this, right? Because we assume that 30% of income you're distributing to your shareholders every year, right? So with that said, you would see, if we go back to the balance sheet, the total liability, actually the total equity every year reduces, because obviously you're paying certain amount of money every year to the shareholders, right? So that's how you have to make the adjustment in your equity. That's what we just did, right? So that's why we have kind of removed this dividend component every year. right? So this can go now because we have made this adjustment. Let's see if there are any more adjustments pending. They're not, and obviously the balance sheet doesn't balance. It would not, which is fine. We'll balance it. We'll balance it eventually. So now let's see what else remains. If there are any items or P&L or Capex that we still, yeah. So this we have already done. So P&L, yeah. So there is another item that we need to, that we have parked because we hadn't really projected our P&L. So this taxation, we already done that. So we can remove this. So I think, yes, we are pretty much done. So we have the Capex, we have the debt schedule built out, we have the balance sheet, we not balance, we'll balance it. We have the income statement. Still, there's an item which we have said we had parked it because we hadn't really built out the Capex sheet. Now we have. So let's put in the depreciation value from the Capex sheet. We go to Capex sheet. Let's plug in these values. Sorry. This value over here. Now you would see it reduces, right? Let me check if I've done this correctly. 17. Right. Right. So this is good. So let's just stop now. We have basically done whatever needs to be done with. The only thing that's left is cash flow statement. Now let's just check if we're being too conservative or we are being too aggressive with our assumptions, right? So let me check. Well, for SG&A, it was 9% the last 2 years. Let me assume that perhaps there again, since they're so cost conscious, the last 2 years, there again perhaps may go to 9%. So this is an assumption. And then check. We have written check here. So let's see, we have assumed 3.2, 3.5%. Let's just go in with this. And again, let me see what's the 4.6. And again, I think we may be a little conservative over here. Okay. Now this number is far too off. I think there is some problem here. Right, guys, I figured out what the problem is. So basically, while I was drag and dropping the formulas in my frenzy, I messed up one formula. So let me fix that. By just going back to the COGS sheet, and perhaps you guys must have noticed. So that's what happens when you kind of do a YouTube video and there's no one to pinpoint. Okay. So right, so this is where I messed up. I did not really drag or drop the formula properly, or might have messed up something else. Right. So I think now it should be fixed. Right. So I think this is looking good. Now, so I think we have done all the projections that we need. And so again, we were talking about, so we have projected the balance sheet, the income statement. We have been, I think, that too conservative in the assumptions. Again, I'm tempted to revisit those assumptions a little bit. But first, let's try to balance the balance sheet. Let's plug in the values of the cash flows, right? So, okay, so this is the cash flow statement, right? So in the cash flow statement, so what we do is, now here we're going to project out free cash flow to equity. And how we do that is we first take the net income, all right? We remove the Capex, we add depreciation, we remove the change in working capital, and we also add any debt issues, okay? So because see, what is free cash flow? Free cash flow is a surplus cash that's left after meeting your free cash flow is the cash flow that's left after meeting your working capital and your capex needs, right? Okay, so that's why we remove working capital. That's why we remove capex. Okay, and we obviously add back depreciation because it's a non-cash item. We add back depreciation, and also we add any net debt issues because it's free cash flow to equity that we're talking about. That's how we estimate equity. If you think about it, looks very similar to a cash flow statement, although prima facie perhaps it doesn't. But let me walk you through as to why this is actually a cash flow statement, right? So you start with net, because this is the way we are actually used to looking at it. Start with net profit, we add back depreciation, we remove the effect of working capital, we arrive at cash flow from operations. Then we remove Capex. That's what we are doing here as well. We basically account for any adjustments, purchase and sales of assets. Okay. And then, so for the future, you don't have to do that. And then you net out any acquisitions, that the amount that you may have spent on acquisitions. Then you get to cash flow to investing, and then you remove any dividends. Okay, and you add any net issues, and then you have your final cash flow. So same thing we are doing here. It's nothing actually different. Okay. Obviously, your free cash flow, we are not really talking about preferred dividends. We're talking about dividends to your common shareholders. So obviously, so first we calculate free cash flows, and then when we talk about cash that would be moved to the inventory. So before we plug in the free cash flow in the balance sheet, we'll actually have to take in the effect of dividends, because we'll have to remove dividends from those cash flows and then plug it in the balance sheet, right? Because that's the cash that's the company is left with, right? After you pay out dividends, and then you issue that. Let me walk you through that. So now to the net profit, let me just, I think now we just need to link the sheet, and that's it. I think we are pretty much done. So net profit, right? So net profit less Capex. Capex we already have from the Capex sheet. Let's do this quickly. Oops, sorry, not PPE. Rookie mistake. Capex addition. Okay, and depreciation needs to be added back. So depreciation again we'll get from this sheet. You can even get from the projection sheet. Let's do this. Change in working capital. We already have projected this out. Right, and then the net debt issues, which we've assumed it would be zero. So that's fine. Let's just link it anyway, right? So free cash flow to equity would be your net profit minus your change in, first let's add depreciation, minus your change in working capital. This is what you do to calculate free cash flow from operations, right? Same thing we have done. And then you arrive at CFI, cash flow from investing. So remove the effect of Capex, and then you add net debt issues, right? This is how you arrive at your, let's see if you have done this correctly, plus B5 minus B6 minus B4 plus B6. Yeah, done this correctly. Let's drag and drop this. Let's calculate the implied growth. Okay, and right, and then so we have made this projection for 5 years. Let's make these projections for the next 10 years as well. So we have assumed that moving forward, right now it's 6.5%. So that's a free cash flow growth at the end of 5 years. So we assume that after 10 years, it's going to slowly, gradually taper to 0.9%, which happens to be the 10-year US Treasury bond rate as we speak. And this is the risk-free rate. So we are assuming that taper to this rate. And obviously, valuation is dynamic. If you do it some time from now, obviously you plug in that different rate, or perhaps you'll make a different assumption, right? So let's assume that our free cash flow increases with this decreasing growth rate, all right? And now we have to calculate terminal value. So guys, terminal value is free cash flow into the growth rate, all right? And then divided by cost of equity minus growth, right? So what's cost of equity? I'll walk you through how I've calculated cost of equity, but let's assume it is what it is, right? I'll walk you through it. Minus G. So we have the terminal cash flow as well. And now let's first balance the balance sheet before we do the part that we have all been waiting for, the fair value per share. Now, the opening cash balance that we had as per the balance sheet was this and this amount, right? at the end of 2019, 8.3 plus 1 billion. So 9.4 billion was the opening cash balance at the start of 2020, or well, at the start of 2020. Now we need to see, so we need to factor in dividends. So let's take in dividends. Dividends was around 1 billion. So the closing balance would be this opening cash balance plus the cash that you generated throughout this year, 3.9 billion, minus dividend that you paid out. That's your closing cash balance. So you see, so you added 3.9 billion worth of free cash flow in your business. So you cannot add the entire thing to your balance sheet, because you obviously need to factor in dividends, right? That's what we're doing, right? Now just do this. So let's do an adjustment balance sheet. Balance sheet, obviously. So balance sheet. So this would be 20. This would be your closing balance, right? In fact, this should be, sorry. All right. So this should be, and again, I'm not really forecasting short-term investment, because at the end of the day, they are cash equivalent, right? So I'm just focusing on these. So we'll get the values of all these guys here. Let me go back to cash flow from equity. So this is opening cash. You can directly, instead of this, I can directly do this. 21. This is the opening cash balance. Let's source it from the balance sheet, because this is the opening cash balance, right? And dividends, we can source it from here, right? Let's source it from here. And then the closing cash balance would be here. So this year, this is the opening cash balance, and this is the free cash flow equity this year minus dividends. So now you just drag this along, right? So you have the closing cash balance, and now you should have the balance sheet. This should appear in the balance sheet as well. You can remove this, and I'm sure the balance sheet still would not balance. I'll tell you why. Let's quickly see as to why the balance sheet is not balancing. It would balance. It would balance. See, sorry, total liabilities. Okay, total liabilities. So we haven't really tracked the formula here for total liabilities. That's one. Okay. So 2272 is the difference between equity and liabilities, between assets and liabilities. So if you remember, you go back to the debt. This 2272, that's the value that we had, right? This we had added, hard coded, because this is the addition that they raised. So obviously, if you kind of add something in the debt, you need to actually have something on the asset side as well, right? So that's the reason why in your balance sheet you have an extra 2.2 billion here, right? So we need to add this here in the asset side. Okay, so let's add it here. In fact, let me source it from here. Again, this is just hard coding. At the end of the day, we are just doing this just that obviously it was a hard coding, so we need to kind of make adjustment on the hard coding. Now the balance sheet balances, right? So now we move on to the free cash flow statement again. So now let's talk about the present value. Okay, first talk about cash equity. So beta is 0.7%, 0.7. Now again, I know I'm going at the top of the hour already, so I would not spend time on beta. Otherwise, I would have loved to show you how we calculate beta. But beta is really your stock price sensitivity to market, how the stock price moves vis-a-vis the market movements, right? So, and the way we've calculated cost of equity is your risk-free rate plus beta times your equity risk premium. Equity risk premium is since this company operates internationally, so we have taken two equity risk premiums. One is the North America equity risk premium, which is at 5.6%. So it's from Professor Damodaran. You should really follow his blog. If you just Google equity risk premium as well, Damodaran, you would really get all the resources that you need. Okay, so 5.6% from the North American market, and because this 87% of 5.6%, because 87% of revenue is drawn from the North American market, and 13% from the international market. And the equity risk premium that I derived for the international market is 7.4% for 5 different regions in which Costco operates, because it draws 13% overall from all those regions as of this moment. right? 13% of 7.4. So that's how we arrived at a consolidated equity risk premium. So beta times consolidated equity risk premium plus risk-free rate of 0.9, which is the 10-year US bond rate, treasury bond rate. So that's how we arrived at 5% cost of equity. Now, if we discount the present value of, we discount equity by this present value. Let's do that real quick. Let's lock P22. Let's drag this along, right? And before we drag this, and hopefully everything is being dragged correctly, right? And now we need to, for terminal value as well, we need to take its present value, right? The present value again would be this time t last year, right? So we have taken the present value for all. So total sum of the present value is the value of equity, the fair value of equity. Okay. So if we divide this, if we divide the fair value of equity by the number of shares, this is the value that we get. This is the fair value for 72. I think this is on the lower side because I think we have been a little bit conservative on the assumptions. So if I just go to my assumption, not because, and right now I think the stock, the last time I checked, was trading at $305. So it seems to be a little bit underpriced, but I think that has to do with the fact that we have actually been very conservative in our assumptions. So let me, this is an equity recommendation. This is just to kind of show you how you model and how you do a DCF, right? This is the purpose basically, right? So this 2% that I've assumed growth rate, I think it could be beyond 2021. It could perhaps on the higher side because again, they are actually going big on e-commerce, and also the fact that historically, at least last 3 years, they've always been above 4-5%, but there has been a decline as well at times. So again, I did not want to go all out here. So this is checked, right? And I think this is good enough because there was a logical way by which we kind of arrived at this, although still low, but okay, let's go in with that, right? So again, so see the value is risen to around $296, around $300 per share. And again, you should never use DCF to get it. In my opinion, my people might disagree. It's fine. In my opinion, you should never use a DCF to arrive at to use it as for point estimates. Okay, should basically play in a range. I would say $300. I think it's close to fairly valued. The stock is fairly valued, I would say. And so now if you're thinking about investing in this, although that's not the purpose of this video. So if you take a look at this, so right now and see for 2020, you would see this fair value. As per this fair value, this should trade at a premium of around PE ratio of around 38, 39, which is actually higher than 37, which trades. The reason being because by the end of 2020, we've, as per assumptions, our earnings would be slightly on the lower side than their trailing 12 months, which makes sense because for the 3 quarters they have actually reported 2613 worth of earnings. Okay, so 3392 minus 2613. So what we are saying is that perhaps they'll report an additional 800 million worth of profit. They may actually report slightly on the higher side. That's fine. Okay, in that case, the share value would be closer to 300. So if you think about it, so if you really think the fair value is closer to 37, which is the level at which it trades, okay, then, and right now it's trading at 306. So if I change my return expectation to say 4%, right, or 4.5%, right? So then it is then that we'll get around 37. So what we've done is we have taken the earnings that we've projected 5 years out, okay, and use these earnings, okay, to calculate the PE based upon our return expectations. Okay, So that's how we have arrived at. So if you believe that 37 is the fair value, fair multiple that it should trade 5 years out, the multiple that it's trading at, then it should really, the appreciation that in the stock that you should get is around $83, which is around 27% over a period of 5 years, which is around 4.5% CAGR for the next 5 years, right? So anyways, guys, I'm sure you can do a ton of assessments, but I just wanted to give you a view as to how you would really bake in your expectation, and if you're looking to invest at all. This is actually very stable stock, stable business, and as and when more news comes in, I'll be happy to kind of change my assumptions and replace them with what the management says or what the market believes. So right now they're obviously being very cautious in terms of their future forecast because of this pandemic. But again, hopefully you kind of learned something from this video. And I also have BJ's PE as well, which trades at a much lower PE, and it actually has 217 clubs right now. Uh, they call clubs instead of warehouses. So if I divide the total revenue by the number of clubs, so they basically make around 60 million per club every year. But if you compare it with Costco, they make around 195, which is like more than 3 times what Costco makes per warehouse or per club. Right? And same thing, same story is true for revenue per square foot of space as well. And all right, so this is guys. Hope you learned something. And so this is what I had on modeling. And please leave any comments, any feedback you have in the comment section, or if you have any doubts, just write to me, and I'll be glad to learn a thing or two from you. Right? So thank you.